Brad Williams, Frugal Finance, Seconds, Piggyback Loans. This information is from CFPB. I don't agree with it. That's okay. I'm going to argue the pros and cons of a second using a piggyback structure or a single loan that is greater than 90%, 95%. The question is, what is a piggyback second mortgage? A piggyback second mortgage is a home equity loan or home equity line of credit that is made at the same time as your main mortgage. The purpose is to allow borrowers with low down payment savings to borrow additional money in order to qualify for a main mortgage without paying for private mortgage insurance. Typically, borrowers with a down payment less than 20% of the home's price will need to pay for mortgage insurance. For example, a borrower that can afford a 10% down payment would typically pay for the first 10% of the home price with their down payment and the remaining 90% of the price with a mortgage that requires mortgage insurance. When using a piggyback mortgage, lenders structure the loans differently. For example, the same borrower might pay for the home with a 10% down payment, 80% main mortgage, and 10% piggyback second mortgage. In this scenario, the borrower is still borrowing 90% of the value of the home, but the main mortgage is only 80%. The piggyback second mortgage typically carries a higher interest rate, which is also often adjustable. These programs are offered under a variety of lender-specific brand names, but follow the same basic structure. The piggyback structure was common during the mortgage boom in the early mid-2000s. It is rare today, but good return. Under the rules during the mortgage boom, borrowers did not have to pay for mortgage insurance with an 80% main mortgage. Now, my argument is, and we'll go into here and talk about a few tips. I owned a mortgage company for a long time. The 80-10-10 rule was common. The reason being is when you're in this 90% loan to value, 95% loan to value, 97% loan to value, and back in the day, you could borrow up to 105% to cover closing costs, so on and so forth. What you need to determine is the difference between an 80-10 and no mortgage insurance versus a 90% with mortgage insurance. Now, if you really want to do the numbers, check out my video under mortgage and real estate. That's the finance side of Frugal Finance. I use a lot of computations to determine what the overall cost of that extra 10% of a piggyback, if you did it, what's called an 80% first, 10% second, and 10% of your own equity. Clearly, it's expensive, but I didn't do a comparison between the mortgage interest costs and the added incremental cost of a second. You can check that out. In the end, I think it's a push. I don't think one way or the other there's any disadvantage to doing either or. Take a look. I didn't take into consideration the tax advantage either. Now, we're going to go into these tips here. For example, if you're considering a piggyback mortgage, here are some questions to ask yourself. Is the piggyback structure really cheaper? Consider the cost of both the main mortgage and the piggyback mortgage. Ask to see a quote for the same loan structured as a single loan with mortgage insurance and compare total cost. But you're not going to find a loan officer who's going to do a present value analysis like I did in that video, comparing the incremental costs of a second mortgage. So you can check that out. Will the piggyback structure make it difficult to refinance your mortgage later? No, it's a snap. It takes a little bit of time. All you do, or all the mortgage folks will do, well, they'll just send a letter, and the second will generally, it's called subordinate. They'll just subordinate the second, provided that nothing on your end has changed. Might have to provide a little bit of documentation, but I've never had a problem in regards to subordinating a second to a refinance. Keep in mind, if you take out a cash out refinance, take into consideration that second. Is that second lien holder in a worse position after you take cash out? And if it is, the second lender won't accept that subordination, and subsequently you won't be able to take out as much cash, or they just say no way, and that would be the challenge. Then you refinance the first and the second under one deal. But comment, let me know what strategy you're using. Now keep in mind, there's more risk the less money you put in, and subsequently your rate is going to be significantly higher if you take a 90% loan versus an 80% loan or a 95% loan. That's what you need to compare. Brad Williams, Frugal Finance. Thanks for watching. Hope that helped. See you soon.